Welcome back to the Deep Dive. It is Monday, February 16th, 2026.
Great to be here.
Today, we are not just looking at a company. I think we're looking at, well, a tectonic shift.
That's a good way to put it.
I want to start with a number that, quite frankly, stopped me in my tracks when I was going through the research stack this morning.
Oh, I think I know which one you're talking about.
By 2028, so that's just 2 years from where we sit right now, India is projected to be the fourth largest private wealth market on the entire planet.
It is a staggering statistic. And when you really sit with that number, you realize we aren't just talking about GDP growth or, industrial output.
No, this is different.
We are talking about the accumulation of private capital on a scale that we haven't seen in this region perhaps ever.
Fourth largest in the world. I mean, that puts India right up there with the Titans. But here's the thing that I think people miss. It's not just that the pile of money is getting bigger.
No.
The location of that money is changing. We're talking about value migration.
Exactly. And that is the core theme of today's deep dive. Value migration.
It sounds like a term you'd hear in a boring economics lecture, but let's unpack it. Because when you strip away the jargon, we are talking about a fundamental change in the Indian psyche, aren't we?
We are. For the last 50, maybe 70 years, the Indian household savings playbook was, well, it was written in stone.
Absolutely.
It was defensive. You buy physical assets. You buy gold jewelry for your daughter's wedding. You buy a second flat in your hometown.
Or you put money in a fixed deposit at the bank because the bank manager is your neighbor.
Yes. That was the definition of wealth. It was tangible. You could touch it. You could feel it.
Right. The land and gold strategy is what our parents did. It's what their parents did. It was safety first, growth second. But the research we have in front of us suggests that script is being shredded.
It is being rewritten in real time. We are seeing a historic shift from those physical assets to financial assets.
Okay, so define that. What are we talking about?
We're talking about stocks, mutual funds, alternative investment funds, private credit. The money is moving from the safety deposit box to the market. And this brings us to the subject of today's deep dive.
Nuvama Wealth Management.
Exactly.
Now, for the uninitiated, this isn't just another broker. We are looking at them as a lens, really, to understand this entire macroeconomic shift. As of today, early 2026, they are managing over 4.6 trillion rupees in client assets.
Let's put that in dollars for our listeners. It's roughly 54 billion US dollars.
For 54 billion.
That 54 billion tells you everything you need to know about the scale. But what's even more interesting is the context of why now.
Right.
We are sitting here in February 2026. The last 18 months have been, let's call them interesting for the financial sector.
That is a very polite way of putting it. We had the regulatory crackdown in late 2024. Specifically regarding index derivatives, we've seen market volatility.
Precisely. And despite those headwinds in the capital markets, which we will absolutely discuss in detail later, Nuvama has shown incredible resilience.
How so?
Their wealth management arm has continued to grow even when trading volumes dipped. This highlights the thesis. The wealth story in India is structurally stronger than the trading story.
So our mission today is to figure out if this is the real deal. How does a company actually manage 4.6 trillion rupees? What is the difference between being rich and being wealthy in this new ecosystem?
And the big question.
The big skeptical question I have is this a structural growth story that lasts for decades? Or is this just a cyclical boom that's going to vanish the moment the Nifty takes a nosedive?
That is the multi-billion-dollar question. To answer it, we have to start at the macro level. We have to look at the gold to stocks shift.
Let's dig into that, because in the pre-show notes, there was a comparison that I think really frames the opportunity size. You compared India's financial wealth to GDP ratio with matured markets.
This is the single most important metric. If you take nothing else away from this deep dive, remember this gap. Currently in India, the financial wealth to GDP ratio sits at around 25%.
Okay, 25%. Meaning the total value of financial assets held by individuals is about a quarter of the country's GDP.
Correct. Now, look at a matured market like the United States or the UK. That ratio isn't 25%.
What is it?
It is approximately 70%. 70.
Wow. That is a massive delta, 25% versus 70.
That 2.8x gap represents the untapped potential. It tells us that the vast majority of Indian wealth is still locked up. It's dormant.
Dormant.
It is in real estate, it is in gold, it is in the unorganized sector. It hasn't entered the formal financial system yet.
It's interesting you use the word dormant, because I think about the typical business owner in a place like Surat or Ludhiana, like let's call him Mr. Patel.
A classic example.
He runs a textile business. He's incredibly rich. He has cash flow.
Huh.
But where is his net worth? It's in the factory land, it's in the inventory, and it's in gold biscuits in a vault.
Exactly. Mr. Patel is asset-rich, liquidity-poor, or at least financial asset poor. His money isn't working for him in the global markets. It's sitting there protecting against inflation, maybe, but it's not compounding at 15% or 20%.
So the job of a company like Nuvama isn't just to manage money that's already in the market. It's to convince Mr. Patel to move his money from the vault to the market.
That is the value migration. It is moving from store value to growth of value.
And the market size for this service,
Yeah,
it's still tiny, right?
it's shockingly small. Here is the kicker. The market cap of the entire wealth management sector in India is estimated at just 0.9 trillion rupees.
Wait, 0.9 trillion? I mean, that sounds like a lot in isolation, but relative to the banking sector.
It is a drop in the ocean. It is less than 1% of the broader financial services sector.
Less than 1%.
In matured markets, wealth management firms are giants. They're household names. They make up a huge chunk of the financial industry. In India, it is a tiny sliver.
And the number of players.
There are less than 5 scaled wealth managers that exist to serve a country of 1.4 billion people.
Less than 5. That seems impossible. I mean, we see ads for mutual funds and trading apps literally everywhere.
Ah, but there is a difference between a trading app or a distributor and a wealth manager.
Explain that difference. It's important.
A trading app is a tool. It's a piece of software. A wealth manager is a holistic service. It's advice, it's planning, it's succession.
It's the human element.
It's the human element. And for the scaled players who can handle ultra-high net worth complexity, you can count them on one hand. And yet the demand is fragmented across 450 plus locations.
So you have this massive supply-demand mismatch. You have millions of people getting richer, needing advice, and very few large institutions to give it to them?
Precisely.
Who exactly are these people? Let's define the target demographic.
We usually break it down into 3 buckets. First, you have the affluent.
Okay.
Then you have the high net worth individuals, or HNIs. And at the top of the pyramid, the ultra high net worth individuals, or UHNIs.
The UHNIs, the super rich, the private jet crowd.
Yes. As of mid-2025, the market data suggests there are about 1.3 million affluent and HNI clients.
1 million plus, that's a big pool.
It is. But then you have over 4,400 wealthy families that fit that ultra high net worth criteria.
4,400 families holding a massive amount of the country's wealth. That sounds like a very concentrated market at the top.
It is concentrated at the top, but the growth, and this is key, is coming from the layer below. The demographics are shifting. We are seeing the rise of the nouveau riche in Tier 2 and Tier 3 cities.
Going back to our friend Mr. Patel in Surat, or the tech entrepreneur in Indore.
Exactly, and their behavior is changing. We call this financialization.
Right.
Look at the growth rates. Bank deposits, your traditional savings account, are growing at about 11% to 14%.
Which is decent. It keeps pace with nominal GDP, roughly.
It's decent, but it's not spectacular. Now look at mutual funds. They were growing at a 21% CAGR.
Compound annual growth rate. Much, much faster.
And then look at alternative investment funds, or AIFs. Are you ready for this number?
Let's hear it.
A staggering 68% CAGR.
68%. That is insane.
It is exponential. It shows that people aren't just getting richer, they are getting smarter about how they hold their money.
Right.
They are chasing yield. They realize that a fixed deposit effectively loses value once you factor in tax and real inflation. If they want to preserve wealth across generations, they have to enter the markets.
So the tide is rising, and the boats are changing from rowboats to speedboats. Let's talk about the captain of one of these speedboats, Nuvama.
Nuvama Wealth Management.
Now, for those who've been following the markets for a while, the name Nuvama is relatively new. But the company isn't, right?
Correct. This is a classic case of rebranding and restructuring. Nuvama was formerly associated with the Edelweiss Group, a massive name in Indian finance.
Right, Edelweiss. I know that name.
But it spun out, and now it is majority owned by PAG.
PAG being the Asia-focused private equity giant.
Yes. And that ownership structure is important. Institutional ownership, especially from a top-tier PE firm, usually brings a level of discipline and a relentless focus on shareholder value that you don't always get in, say, a family-run conglomerate.
A different kind of pressure, a different kind of focus.
Absolutely. But strictly looking at the business today, they are managing that 4.6 trillion rupees for 1.3 million clients.
To understand how they do that, we need to break down their operations. Because it's not just one thing. It seems like they have three distinct pillars.
They do. And understanding these three buckets is key to understanding their business model. Pillar number one, and the most important one, is wealth management.
The core, the main event.
The core. This is where they do advisory, estate planning, and even lending for the rich. As of the third quarter of FY26, this segment generated about 57% of their revenue. This is the bread and butter.
Okay, so that's sitting down with a client and saying, here is where you should put your money. What's pillar number two?
Pillar number two is asset management. This is where they create and manage the investment products themselves. Things like alternative investment funds, AIFs, or portfolio management services, PMS.
So in pillar one, they advise you to buy a fund. In pillar two, they build the fund.
You've got it. And pillar three is capital markets.
So investment banking.
Yes, institutional equity broking, investment banking, and custody services.
Okay, I want to pause here. Because if I am a listener, I'm thinking, if I'm a wealth manager and my job is to help rich people manage their money, why do I need an investment bank? Why do I need a capital markets arm? Isn't that a totally different business?
That is a great question, and on the surface, they look like different businesses. But Nuvama calls it the One Nuvama approach. Think of it as the entrepreneur flywheel.
The entrepreneur flywheel. Okay, that sounds like a marketing term. Unpack that for me. Because usually when companies talk about synergy, it's just fluff.
Well, in this case, it is actually structural. Imagine you are a business owner. Let's stick with our friend, Mr. Patel.
Okay, Mr. Patel from Surat.
He has built a successful logistics company. He wants to take it public. He wants to do an IPO. Who does he call?
He calls an investment banker.
Right. He calls Nuvama's capital markets team. They handle his IPO. They price it. They sell it to institutions. Now, the day he rings that bell at the stock exchange, what happens?
He gets rich. On paper, at least. The company is now worth thousands of crores.
Precisely. He creates a massive liquidity event. Suddenly, he has shares worth a huge amount of money. But there's a catch.
There's always a catch.
Usually there is a lock-in period. He can't sell all of it immediately. But he is now, officially, a high-net-worth individual who is standing right there having just helped him list his company.
Nuvama.
Nuvama's wealth management arm. They say, congratulations on the IPO, Mr. Patel. Now let us help you manage this new fortune.
I see.
The investment bank creates the wealth. The wealth manager captures it.
That makes perfect sense.
Yeah.
But play devil's advocate for a second. Isn't there a potential conflict of interest there?
How so?
Well, if Nuvama is banking the IPO, they want the highest price possible for Mr. Patel's company. But if they are advising their other wealthy clients to buy into the IPO, those clients should want a fair, reasonable price. How do they manage that tension?
That is the eternal tension in integrated financial firms. There have to be strict Chinese walls information barriers between the investment bankers and the wealth advisors.
So they're legally not allowed to talk to each other about certain things.
Exactly. But from a corporate strategy perspective, having the capital markets arm gives them first look at the liquidity event. They are in the room when the money is made. A pure play wealth manager is standing outside waiting for the phone to ring.
That is a huge advantage. Access.
It is. And the evidence that it works is in the data. This cross-segment synergy reduces their client concentration significantly.
What do you mean by that?
Their top 5 clients contribute less than 10% of their revenue.
That's surprisingly low.
It's very low for this industry. It means they aren't dependent on just 1 or 2 mega billionaires because they have this constant funnel of new entrepreneurs coming in from the capital market side.
Now, we talked about how few players there are. But Nuvama isn't just sitting in a skyscraper in Mumbai waiting for people to walk in. They have a massive distribution network.
This is one of their biggest competitive moats. Distribution power. They aren't just in the metros in Mumbai and Delhi.
Right.
They have a network of over 19,500 sub-brokers.
19,500. That is an army.
It is an army. And they have a presence in over 450 locations.
But again, I have to be skeptical. Can't anyone just hire a bunch of brokers? Why is this a moat? If I'm a competitor with deep pockets, can't I just go hire 20,000 people tomorrow?
You could try. But building a sub-broker network of that size, it takes decades.
Why?
Decades of relationship building, of regulatory vetting. You have to train them. You have to ensure they are compliant with SEBI regulations. You have to build the tech stack that connects them all. It is a logistical mountain.
It's the boots on the ground advantage. You can't code your way around that.
You cannot. And it allows them to distribute a massive width of products. They aren't just selling simple mutual funds that you or I could buy on an app.
What are they selling, though?
They are distributing complex private equity funds, commercial real estate products, structured debt, things you can't just buy on a generic trading app. You need a human to explain it.
Which brings us to the money.
Yeah.
How does this machine actually generate profit? Because there's been a shift in the industry regarding fees versus commissions, right?
This is critical to understanding the quality of their revenue. In the old days, the model was transactional.
The churn and burn.
Exactly. I call you, I tell you to buy a stock, you buy it, I get a commission. Then tomorrow I tell you to sell it and buy another one so I can get another commission.
It creates a perverse incentive. I make money when you trade, not necessarily when you profit.
Right. It's not aligned with the client's best interest. The new model, and where Nuvama is heavily focused, is advisory, or ARR.
Annual recurring revenue.
Right. I charge you a fee based on the assets I manage for you, a percentage. Whether we trade or not, I get paid a percentage to keep your wealth growing.
So if the portfolio goes up, the fee goes up. If the portfolio goes down, the fee goes down. We're in the same boat.
Precisely. Nuvama is heavily focused on what they call MPIS managed products and investment solutions.
MPIS. I see this acronym all over their investor decks. Why does it matter so much?
It matters because it represents high-margin, sticky revenue. This is the money that comes in year after year like a subscription.
It's predictable.
It's predictable. And as of FY 2026, we are seeing a clear trend. Wealth management revenue is up approx 21% year over year in the first 9 months of FY 26. But capital markets revenue, it's down.
Because of those regulations we mentioned earlier, the SEBI crackdown.
Right, but because they have shifted the mix towards this steady wealth management income, the business is resilient. If they were purely a brokerage, 2026 would have been a disaster. Because they are a wealth manager, it's a growth year.
I want to talk about operating leverage. We hear this term a lot with tech companies. Software is scalable. But how does it apply to a wealth manager, which involves humans?
Think of it like running a luxury hotel.
Okay, I love a good hotel analogy. Break it down for me.
To build the hotel, you have huge fixed costs. You have to buy the land, build the structure, hire the core staff, set up the IT systems, get the licenses. That costs a fortune.
Right.
Your first guest is incredibly expensive to service because you built a whole hotel just for them.
But once the hotel is built,
the cost to check in one extra guest is tiny. Maybe a little laundry, some electricity, the cost of the little shampoo bottle. The marginal cost is near zero.
and the revenue from that guest is almost pure profit.
Exactly. Nuvama has built the hotel, the technology platform, the core staff, the compliance teams. Now, as they add more assets, more billions of rupees, their costs don't go up by the same amount.
So the revenue scales, but their costs stay relatively flat.
That is operating leverage. We can see it in their cost-income ratio. It improved to around 62% in FY24, and they are targeting 55%. Every percentage point that drops is pure profit falling to the bottom line.
And they're using tech to do this too, right? It's not just people.
Oh, huge tech efficiency. They have partnerships with firms like ClickTech and use tools similar to what you see in fintechs like Zeroda. This allows their relationship managers, the RMs, to handle more clients without burning out.
So if an RM used to be able to handle 50 families, maybe
Yeah.
with this tech they can handle 80.
Exactly. And that drives the return on equity, or ROE.
The ultimate measure of profitability.
For the first 9 months of FY 2026, Nuvama's ROE was around 28.4%.
28.4%. Let's put that in context. A typical good bank like an HDFC or ICICI might be happy with 15% or 16% ROE.
Correct. 28% is considered top tier in the financial industry. And the reason it is so much higher than a bank is because wealth management is capital light.
Explain capital light for the listener who might be used to looking at bank balance sheets.
A lending bank needs a huge capital buffer. If they lend out $1 billion, they have to keep a big chunk of their own money in reserve to protect against defaults. It requires a lot of heavy equity on the balance sheet.
Right.
A wealth manager, they're mostly managing other people's money. They don't need to hold massive reserves against it, so the returns on their own smaller base of equity are much higher.
So high returns, scalable model, massive market opportunity. It sounds perfect, almost too perfect. So where do they go from here? What is the growth strategy?
They have a multi-pronged attack plan. The first is simply penetration of existing clients.
Getting a larger share of wallet.
Right. Let's go back to Mr. Patel. Let's say he has a total investable surplus of 100 crores. Maybe he only gives Nuvama 20 crores to manage right now.
He's testing them out. Diversifying his risk.
Exactly. He keeps the rest with other banks or maybe in a different brokerage account. Nuvama's goal is to prove themselves and get that client to move the other 80 crores over. They want to be the primary advisor.
And they're targeting net flows of 19,000 to 20,000 crore rupees annually. Just new money coming in the door.
Correct. That's the organic growth from existing relationships. The second prong is capacity expansion. This is the human element.
Right.
They plan to double the number of relationship managers over the next 3 to 5 years.
Doubling the sales force. That is aggressive. But this brings me to a major bottleneck. Is it hard to find that talent? I mean, you can't just pick someone off the street and say, here, manage this billionaire's portfolio.
It is incredibly hard. And frankly, this is one of the biggest operational risks for the entire industry. The talent pool for high-quality private bankers in India is shallow.
So everyone is fighting for the same people.
Every firm is fighting for the same people. There's a poaching war constantly going on.
So they have to train them, build them from scratch.
They have to build a training academy, essentially. They have to hire fresh talent and mold them over years, which takes a lot of time and money.
Okay, so existing clients, more RMs, what else?
Going digital and regional. They are pushing into Tier 2 and Tier 3 cities using what they call a phygital model.
Phygital. Physical plus digital. It's a terrible word, but explain the strategy.
It works like this. You have a digital app for the basics, execution, reporting, simple mutual fund buying. That handles the volume and the day-to-day.
Right.
But you have a physical office or a local sub-broker for when the client needs to talk to a human for the big decisions.
Because Mr. Patel in Surat might use an app to check his balance, but if he's going to invest 5 crores in a private credit fund, he wants to look someone in the eye.
Exactly.
Yeah.
Trust is physical, transaction is digital. That is the phygital model.
And they're also looking outside of India, right? I saw a note about Dubai.
Yes, new geographies. They established a subsidiary in Dubai, in the DIFC.
Why Dubai? Is it just for tax reasons or something more?
It's about following the money. A lot of Indian wealth has moved to Dubai, both from promoters and professionals, and a lot of NRIs, non-resident Indians in the Middle East, want to invest back into the Indian growth story.
So Nuvama wants to be the bridge for that capital.
Precisely. If they don't have an office in Dubai, they lose that client to a global bank like UBS or fierce local competitors who are already there.
And finally, new products. I saw something about commercial real estate.
They are launching a commercial real estate fund, a joint venture with Cushman and Wakefield, and they are focusing heavily on private credit.
Private credit seems to be the buzzword of the decade. Everyone is doing it.
They are, but for a good reason. As the wealthy seek yields that consistently beat inflation, they are looking beyond the stock market. Private credit lending directly to companies offers those higher, often floating rate yields.
And it's less correlated with the public markets.
Correct. Nuvama wants to package that and sell it to their clients. It's about having products on the shelf that the bank down the street simply doesn't have.
Okay, we have painted a very rosy picture. Massive growth, great margins, smart strategy. But we are the deep dive. We don't do fluff pieces. We have to look at the dark clouds. What can go wrong?
There are 3 main buckets of risk here, and they are significant. The first, and the scariest, is regulatory risk, the SEBI factor.
The Securities and Exchange Board of India.
The financial sector in India is heavily regulated, and SEBI is very, very active. We saw this play out specifically in November 2024.
Remind us what happened there.
SEBI tightened the regulations on index derivatives. Basically, they made it harder and more expensive to trade options and futures. They increased lot sizes. They limited the number of expiries.
Because they were worried about retail speculation.
Yeah, right.
Too many people gambling their savings away on daily options.
Correct. It was a move to protect the small investor, which is their mandate. But for a company like Nuvama, whose capital markets arm facilitates those trades for institutions and HNIs, it was a direct hit to the P&L.
How bad was it?
Volumes dropped. In Q4 of FY25, capital market volumes were down something like 27% quarter on quarter.
Wow, that is a massive air pocket to hit. You lose a quarter of your volume overnight because a regulator signed a piece of paper.
It was. And the future fear is that SEBI could do more. They could cap commissions on mutual funds. They could increase margin requirements further. A single circular from the regulator can slash fee income overnight. You live and die by the pen of the regulator.
That's a sobering thought. What's risk number 2?
Cyclicality. The market mood.
Markets go up, markets go down. We know this.
We know it, but wealth managers are, to some extent, bull market babies.
Yeah.
When the Nifty index drops 20%, Two things happen immediately.
Go on.
One, the value of the assets they manage drops. If I manage 100 rupees for you and the market falls 20%, now I manage 80 rupees. My fee is a percentage of that, so my revenue drops 20% instantly, even if the client does nothing.
So they have direct exposure to asset prices.
Right. But the second impact is psychological. Client sentiment turns sour. People stop investing, they stop trading, the flows dry up.
Mr. Patel decides to keep his cash in the bank instead of giving it to Nuvama.
Exactly. And it gets worse. Nuvama also has a lending book, right? Lending against securities, or LAS.
Explain that risk.
They lend money to clients using their stocks as collateral. It's a great business in a bull market, but in a crash, the value of that collateral falls. This leads to margin calls.
So they have to call the client and say, you need to put up more money or more stock.
And in a panic, the client might not be able to. Then Nuvama has to liquidate the assets into a falling market. It can get messy very quickly. If liquidity dries up, they could be left holding bad loans against worthless collateral.
So crash hits them on fees, on flows, and potentially on their loan book. It's a triple whammy.
Correct. And the third risk is what I call the Jerry Maguire problem, key person risk.
Show me the money.
Wealth management is a relationship business. Clients trust their specific relationship manager, not necessarily the logo on the door.
Right.
If I am a client, I trust you, my advisor. We play golf together. You know my kids' names. I don't care if you work for Nuvama or a competitor. I trust you.
So if a star RM leaves to join a rival firm,
They might take 500 crore rupees of client assets with them.
they walk out the door with the Rolodex and the money.
It happens all the time in this industry. It's a constant threat.
But wait, Nuvama talks about institutionalizing the relationship. That sounds like corporate buzzword bingo. How do you actually stop a client from following their favorite advisor? Do they use non-competes? Golden handcuffs?
They use all of those, but the most effective tool is product stickiness. If the client is invested in a Nuvama private equity fund or a specific structured product that has a 5-year lock-in,
They can't leave.
they can't move that asset easily. The more complex proprietary products the client buys, the harder it is to leave.
So complexity is a retention tool.
Cynically, yes, but practically it is about offering value that the individual RM cannot replicate on their own. But the risk remains high. It is a people business.
Let's talk about the people at the very top, the leadership. Because with any financial firm, you are betting on the jockey, not just the horse.
The captain of the ship is Ashish Kehair, the MD and CEO.
What's his background? Is he a growth at all costs guy or a risk manager guy?
He is a veteran of private banking. He led the transition from Edelweiss to Nuvama. While we don't have a deep biography in the notes, the results speak for themselves. Under his tenure, Nuvama has solidified its position as the #2 independent wealth player in India. He has navigated the spin-off, which is never, ever easy.
And the owner. We mentioned PAG earlier.
PAG acquired the majority stake in 2021. This is crucial because institutional ownership usually brings discipline. Private equity firms are focused on one thing: shareholder value.
Right.
They want to clean up the balance sheet, improve governance, and eventually exit at a profit, usually in a 5 to 7 year time frame.
Which means they are aligned with making the stock price go up.
Generally, yes, but there are blind spots.
Governance gaps, what do you mean?
Well, we don't have clear data on executive compensation. We don't see specific clawback provisions. What happens if a manager takes too much risk and blows up? And the details of the split from Edelweiss regarding legacy issues are a bit opaque.
So for a minority shareholder, you are flying a little bit blind on those soft governance metrics.
Exactly. You have to trust the institutional backing of PAG, but you should always keep an eye on those disclosures. These are things to watch in the long run.
Okay, let's bring this all together. We have covered the macro shift, the business model, the growth engines, and the very real risks.
If we synthesize this, Nuvama is essentially a pick and shovel play on the Indian wealth story.
Explain that for the listeners who haven't heard the term.
During the gold rush, the people who made the most reliable money weren't the ones digging for gold. That was a gamble. It was the ones selling the picks and shovels to the miners.
They made money no matter who found gold.
Exactly. Nuvama doesn't need to predict which stock will go up. They don't need to know if tech is going to beat pharma. They just need the Indian ecosystem to keep growing.
As long as Indians are getting richer and investing their money somewhere, Nuvama wins.
Correct. And the resilience they showed in FY 2026 proves this. The capital markets arm took a hit from regulation, but the wealth management arm kept growing and offset that weakness. The diversification worked.
So what does this all mean for the listener? What's the final thought here?
It brings us to a final provocative thought. We talked about Nuvama doubling its relationship managers. They are hiring thousands of humans.
In the age of AI.
Exactly. In an age of robo-advisory, ChatGPT, and algorithmic trading, Nuvama is betting that the future of wealth management is actually more human, not less.
That's a contrarian bet. Everyone else is trying to automate everything and cut costs.
It is. Nuvama is betting that the richer you get, the more you want a person, not a bot, to hold your hand. When you are talking about your life savings, your legacy, your children's inheritance, you want empathy, you want nuance, you want trust.
A bot can calculate the yield, but a bot can't talk you off the ledge when the market crashes by 30%.
Exactly. If Nuvama is wrong, their biggest cost center people becomes their biggest liability. But if they are right,
Then what?
if they're right, they own the last mile of trust in a digital world.
That is a fascinating way to look at it. They are betting on the value of human connection in a digital age.
And that is a bet worth watching very closely.
Absolutely. Well, that brings us to the end of this deep dive. I want you, the listener, to take a look at your own portfolio. Are you part of the 25% investing in financial assets, or are you still stuck in that piggy bank era?
The tide is turning. Don't get left on the shore.
Thanks for listening. We will catch you on the next deep dive.